Hello and welcome to this webinar on how to build a balanced bond portfolio in collaboration with FIIG. Welcome to all our guests and participants in today's webinar. All right, we'll get started now. Just to give you an agenda and flavor for what's coming ahead. Firstly, a round of introductions. My name is Prashant. I head up the marketing team here at Sharesight. And I've been with Sharesight for over 6.5 years. We'll go into a round of introduction to our key speaker today. But in terms of what follows after that, we'll do a bit of a role of bonds in a balanced portfolio, and then followed by the actual webinar content. And then finally, we have some time for Q&A. So all up, we should be done in about 40 minutes, 45 minutes, including the Q&A. But if there are any urgent questions, Philip is happy to hang around and answer any of them right at the end. A bit of a disclaimer, and I'm sure Philip has a FIIG version of this as well. But from Sharesight's point of view, this is definitely not a product recommendation. It's purely for informational purposes. And yeah, nothing we say here is something that you should take into consideration without consulting your accountant or financial advisor. Now, introducing our key speaker today, Philip Brown. Thank you so much, Phil, for coming on to our webinar. And Philip has been with FIIG since 2023. He's a veteran of the fixed income side of various banks. He's got a 20-year research career in working for various fixed income and government research teams in banks. He was a senior fixed income strategist at CBA just before he joined FIIG. He was part of the team that actually won the best research on government bonds as awarded by Kanga News. Now, he's got a very quantitative background. He's a total numbers sort of guy, but his gift is the fact that he can convert that to normal language and explain it really well. Melbourne born and raised, and we just had a discussion that Melbourne's actually in pretty good sunny conditions today. So with that, I'll hand over the presentation to Phil, and over to you, Phil.
Thank you very much for that kind introduction. Yes, some levels it's a little bit unfortunate you can see my office behind me because I'm looking out over a beautiful sunny Melbourne day. It's winter appears to be over, which is wonderful news for those of us who live in the south. Now, if you'll just give me 1 second, I will press the requisite buttons to start sharing my presentation. Today is entitled, Portfolio Construction, Art or Science? And the answer to that is that, like a lot of things when you get asked, is it art or is it science? It's a little bit of both. What you need to understand is what the benefits of having bonds in your portfolio are and what the risks are. But as Prashant so cleverly forecasted, I do indeed have a disclaimer, which I just need to tell you. FIIG Securities is not offering you personal advice. I know nothing about your personal circumstances, so please do not construe what I'm saying to be personal advice to you. It is general advice only. Now, art or science? As you can see, the very famous Leonardo da Vinci Vitruvian Man. What this is saying is that in art and in science, the beauty is in the balance. That is what we are trying to achieve with a bond portfolio, a balance to provide us surety and protection without giving up all our income. The concept of how you use bonds to create that beautiful balance inside a portfolio is that it's leaning into the concept of diversification. Most of you who are, I believe, share investors as a general rule will be very aware of the idea of having a diversified share portfolio. Oh, sorry. I've just been sent a poll. There we go. Most of us who are familiar with investing in shares will know that you need to diversify your share portfolio. that's actually broader than that. You shouldn't just diversify your share portfolio, you should diversify your entire investment holdings. So you should have some shares which are growth assets, you should have some diversifying assets like property, and also if you're trying to guarantee your income or to protect your capital, what you should be looking at is some bonds. Now, how does this work? This works because bonds are not quite as high return as shares. Bonds have a bad name in the market, which is unfortunate. I'm hoping to try and correct that a little bit today. Bonds do achieve not quite as high a return as shares, but surprisingly close and materially higher than term deposits. It's not actually part of this presentation, but we recently did our 23-24 returns analysis and found that the average FIIG bond investor got 9.48% over the year, which was slightly under the 12% or so you could earn on the ASX 200, to be fair. But what you do get from bonds is something wonderful called negative correlation. Now, how negative correlation impacts bond prices and an investment is that when interest rates rise, bond prices fall. And when interest rates fall, bond prices rise. Now, the other thing most people would also know about interest rates is that interest rates tend to rise when the economy is doing really well. So when the economy is doing really well, share prices are rising, interest rates are rising, and bond prices are falling, that means they're moving in the opposite direction. That's negative correlation. Conversely, if we were to, for example, enter into a recession in 2025, that's not our forecast, I should reiterate that. We're not expecting a recession, but it is sitting there as a tail risk. If we were to enter a significant slowdown in the economy, equity prices would fall, interest rates would fall, and bond prices would rise. So you can see that when you have this negative correlation about equity prices moving in one direction and bond prices moving in the other direction, you have two offsetting parts of your portfolio. That's sort of diversification on steroids. So conceptually, this is how it should work. That if you have a share portfolio which is having big, large swings, moving up and down, but a bond portfolio which is also having swings, but hopefully moving up and down at the opposite time. The result of that is that overall, your portfolio outperforms the cash rate quite significantly without creating too much risk in either direction. That's the concept. Does it work? The answer to that is a qualified yes. This is 12-month annual returns for the defensive bonds, which I'll get into a bit later on what defensive bonds mean. The ASX equity market and the Australian cash rate. Now, what you can see is that, yes, as a general rule, equities outperform bonds for a good part of the time, but then every so often, equities have an absolute shocker of a performance. Minus 30%, minus 40% is quite plausible for equity markets every 15, 20 years or so, which if that's the year that you've decided to retire, that can be a huge problem. Imagine if you'd retired in 2006 or 2007, but everything just nicely worked out, you hit the financial crisis, and a year later, your wealth has halved. If only there was some asset that would perform really well during the period of that really poor performance of equities. Well, have a look at what defensive bonds did over that period. The best performance for bonds in 20 years was that year that equity markets did so poorly. Conceptually, this is because when you hit a big recession, you hit a big economic problem, the RBA slashes interest rates. As interest rates start falling, bond prices start rising. And as you can see, this has largely held true, that the periods where there are significant RBA rate cut cycles, 2003, 2009, 2012, 2019, and 20, mostly those periods have been periods where equities have done poorly and bonds have done very well. So what went wrong in 2020? Why didn't bonds perform properly in 2020? That is basically because there was nowhere left for them to go. Bonds are constrained at a yield of 0. If you're talking about an interest rate, you can't have an interest rate below 0, or at least not materially below 0. So what happened when we hit the pandemic? Bond yields dropped to zero, but could go no further. We had this sort of a shape. You can see here that in 2009, when bond yields dropped dramatically, that big fall in bond yields is a big rise in bond prices. And again, in 2013, a big fall in bond yields, a big rise in bond prices. Now, in 2013. In 2019, we had a fall in bond prices, such that when we got to 2020, 2021, there wasn't much space left. But yields have risen substantially since then. Now, I'm sorry, I just realized that I've jumped into talking about bonds a little bit too quickly, and I may not have fully explained to everyone what a bond is. I know most people on the call will be aware, but just in case there are a few that aren't aware, whereas an equity is when you buy a small part of a company and you receive a dividend because you're an owner of the company, a bond is when you lend money to a company. You agree to receive a fixed amount of cash each year, and then the final payment of your return of your principal at the end. So that's why bonds are called fixed income, and it's why they are constrained at zero. The interest rate can't really go below zero, because otherwise, why would you invest money in a company if what you're actually going to get back from them is less than zero? That's why you have this floor at zero, and that floor at zero is why bonds in 2020 during the pandemic did not behave the way that the textbooks said they should. Now, yields have risen substantially since then. And actually, bond yields have risen so substantially that it completely changes the dynamics. So let's try and answer the question, will diversification work in 2025? To understand how 2025 is different from 2020 and from the years that went before it, we need to take a really long look at bond yields. You see, this chart here shows bond yields over 60 years. So that actually for the last, and it's US bond yields, it must be said, because they have the best, longest data series. Since 1982, US yields have been dropping. Between 1982 and 2002, yeah, there were squiggles up and down, where there's a big, long trend downwards in yields. There are lots and lots of different drivers for this. The peak in 1981 is caused by an incredibly high inflation rate. As you can see there, inflation got up to around 15%, which caused Professor Volcker at the Fed to raise the US cash rate exceptionally high, causing exceptionally high bond yields in the United States. That caused a pretty nasty slowdown in the economy, but it did bring inflation under control. So starting from the 1980s, we had inflation falling, and so bond yields falling a little, which means bond prices rising. Then, as we kept going through the 1990s, you had different factors. US government borrowing fell in the 1990s. There's also something that's often referred to as the Chinese global savings glut. Basically, China had, an exceptionally strong boom phase, and they were creating a lot of excess capital, which the Chinese government and the Chinese people wanted to invest for retirement, but outside of China. That triggered a lot of cash flows into bonds around the world, caused bond prices to fall, bond prices to rise and interest rates to fall. We kept going through the 90s. You also had the Clinton surpluses. So the US government borrowing fell a lot during the 1990s, so bond yields kept falling. You get through into the 2000s and you get the big GFC recession in 2007 that causes even further falls in bond yields. The Federal Reserve started quantitative easing in 2008. They bought huge amounts of bonds that caused bond prices to rise, bond yields to fall. For a decade in the 2010s, the cash rate barely moved and bond yields sat really very low. Bond prices were exceptionally high. And that's where we sat in 2020 when the pandemic started, and there was just no further space for bond yields to fall, and so it was hard for bond prices to rise, which meant that bond prices couldn't provide that offsetting gain in a period of otherwise difficult economic times. But as you can see on this chart, in 2022, things changed. That 40-year trend is now broken. It's not behaving that way anymore, and there is a fundamental reason why. The fundamental reason in my mind is not the pandemic itself. It is, in fact, the government response to the pandemic. Now, this chart here is interesting. it's a little hard to see what it means on first glance. But what we have here is the United States unemployment rate trying to capture what is the general shape of the US economy. Obviously, when the unemployment rate is very high, that's generally a sign that the economy is not very good. And you can see that the 1983 peak there, that's very high as well. When the unemployment rate is very low, that's a sign that the economy is very strong. That's the light blue line. The dark blue line is the US government budget deficit as a percentage of GDP coming off the right-hand axis. Now, what you can see is there's a really strong relationship between the unemployment rate and the budget deficit. This is not because the government deficit causes the unemployment rate or vice versa. It's because both of them are reacting to the overall state of the economy. When the economy is quite strong, the unemployment rate is quite low, and the budget deficit is quite low, or even in fact in surplus. On the other side, when the economy is quite weak, the unemployment rate is quite high, and the deficit is quite high. That correlation held for 60 years. But let's have a look at where we are now. You have the US government running a deficit of around 6% of GDP. You also have the unemployment rate at amongst the lowest it's ever been. And those two are sort of the opposite ends of those ranges, with the exception of a period during the GFC and during the COVID pandemic. Government spending is as high now as it's ever been in the United States, while the unemployment rate is as low as possible. This is a fundamentally different system. This is the US government using its economic power to change the shape of the US economy. What it means is that there will be a continuing call for capital. The US government, and to be fair, I've used the US government here as the example, but the same kind of thing can be said about the US, the UK, Germany, not quite so much Australia, although to some extent Australia, where countries are actively choosing to run deficits to fund infrastructure, to fund change. So we have a situation that if the government is seeking to borrow a lot of money, then they're being asked to pay higher yields for it. So the current yield structure of an economy with relatively strong growth and relatively high inflation and relatively high interest rates because of that strong growth and strong inflation, that is here to stay unless the government fundamentally changes direction. So we think that the US situation and the global situation will continue to see relatively high yields in their bonds until we get to the next catastrophe, which, all going well, is further into the future. So we've now sort of come to the conclusion that there is space for bonds to rise in price if there is a problem. If you buy bonds to sit in your portfolio to protect you in that catastrophe scenario, there is space for bonds to rise in price materially because the yields are much higher than they were before. But what happens to credit risk? If you're buying a bond, isn't that introducing credit risk into your portfolio? And if it's not much use buying a bond for protection, if when you need that protection, the bond itself suffers from a credit default. Now, before we can talk too much about credit default and how to design your bond portfolio, you need to understand the overall capital structure of a company. Now, when you're dealing with a company that's going into liquidation, there's a really strict ordering of who gets paid in what order. This is not the full list, obviously, it's just the largest types of investments. You can see that if there is a company in liquidation, the first person to get paid back is senior secured debt. If you're talking about a bank, the next person is a term deposit. One after that is senior unsecured debt. After that is subordinated debt. After that is hybrids. And should there be any money left after that, that money goes to shares. What this means is that by and large, bonds are either at the top or near the top of this capital structure. They get paid back first, which means that even though defaults are very rare, the word default is actually defined very stringently. In bond markets, if you are not paid in time and on time and in full, then the bond is considered in default, even if what you actually got was a pretty good outcome. We've had situations at FIIG where a company that ran into trouble, sells down their assets, recovers cash, misses a coupon payment or two along the way, and then repays the bond and the coupon in its entirety just 6 months late. That's still called a default. So with that understanding of what a default is, I still say that defaults are incredibly rare. Since the start of, in Australia, there have only ever been 3 investment grade companies that have gone into default. This chart here shows the time horizon, the cumulative default rates over years for each rating grade. You can see that for a AAA security, over a 1-year time horizon across the history of S&P, 1981, 2022, there have not been any defaults. There is a 0.03% of AAA securities have defaulted during their 2nd year. Over 15, which means that as you read along, each year is cumulative. So if you buy a AAA security, well, historically, that 15-year outlook is that less than 1% of AAA securities would default, remembering that even in default, there's a chance you get all your money back. Now, as you move down the capital structure, down the rating grades, you still have very strong performances. BBB is often considered the boundary line between investment grade and non-investment grade investing. You can see that in a, say, on a 3-year horizon, BBB securities, only 0.69% of securities have experienced a default. And as I said, that's 0.69% of securities that didn't pay precisely on time and in full. They may indeed have paid in full, just not quite on time. So it's actually fairly rare. Only once you get down into the sort of the triple C categories are you talking about sort of material chances of risks, 25% chance of default. That's for what we were just talking about was for rated bonds. What about for unrated bonds? These are a little harder to analyze because they're not kept track of by the main rating agencies. But it's worth understanding that unrated bonds are bonds where rating agencies haven't been asked to assign a rating. They are higher return and they are higher risk. There is no intrinsic problem with an exposure to an unrated bond. It's the size of the exposure that is important. Given that you're mostly an equity investing audience, perhaps you should think of unrated bonds as the small caps of the bond world. There are many, many wonderful investments to be found in small cap share investing. There are many, many wonderful investments to be found in unrated bond investing. They are generally higher risk, higher return. As I said, there have been 3 investment grade defaults in Australia in the last 35 years, but there have been more sub-investment grade. The 3 investment grade defaults are HIH, Pasminco, and Babcock & Bowner. Obviously, there's on the sub-investment grade side, you have ABC Learning, Allco Finance, a few others. FIIG has arranged 75 unrated bond issues. Of those 75, there have been 6 defaults, with recoveries ranging from 37.5%. So even in a default, you got like the worst situation we've had for a FIIG or arranged bond, as you would get back 37.5% of the money you invested. And some of those defaults have, in the end, returned a full 100%, but just not on time. So it's officially counted as a default. We've been talking about, the ability of bonds to provide this wonderful protection and diversification. And I did warn at the start that bonds were not able to return quite as high as the ASX accumulation indexes. However, what they have is this much greater stability and, importantly, the ability for gains during the period when share markets are doing their worst. This is data that I made myself using the annual returns of all figure ranged bonds from 2012 to 2024, the full history, all 70-odd bonds. You can see that across that same time period, the cash rate returns a little under 2%. Bank bills earn a little closer to 2%, but still slightly under. Bonds generically, which includes a lot of really defensive government bonds. Now, do you remember when I put that chart right at the start that I said defensive bonds? That was this category, bonds, which is predominantly government and state government bonds. That did a little better over the period, 2.75% or so. Credit bonds, which is bonds with a credit risk premium in them. So that's lending to companies rather than governments. They did about 3.75. Figure ranged bonds, which is this combination of high yield bonds, small cap type bond investing. They achieved 7%, the ASX a little bit over 9%. But, so that's where we're sitting as a relative reference point. It's true that you do have to give up a little bit of yield to get into a bond investment, but you get that wonderful diversification and fixed knowledge of what your returns are going to be and when you're going to get that money, which for people entering into retirement is very valuable. There are some risks, as I said. We have had some losses. This is the annual return of each bond which FIIG has issued. As you can see, there have been some poor results where there's a 3-year bond with an average return of minus 25%. That's how we got the 37.5 recovery rate. But actually, the vast majority of bonds return 6 to 8 to 10 type % per year. That's a very strong return. And as you can as we've been discussing, and as you would be aware of from share investing, it's quite important to keep diversification within your bond portfolio as well. You should never have just one bond inside your bond portfolio, and you should have a mix of bonds. And so if you look at this, even if you did fairly poorly and you happen to get the minus 26, the minus 10, a 6, an 8, and a 10 across your, and then the rest in the 6, 8 to 10 category across your 10 bonds, you would still end up with quite a healthy return from your bond portfolio. It's very unusual for a bond portfolio to take a significant loss. It can happen, but it requires either a really material rise in interest rates or widespread defaults and an absolute calamitous economy. As a general rule, bonds just do not have the same level of drawdown that equities do. And in fact, in the periods that equities are having significant drawdown, that's when bonds come to the fore and have their best returns ever, as a general rule. So let's talk a little bit about how to put interest rate risk into your bond portfolio. Interest rate risk is how exposed you are to interest rates. Most people are familiar with this concept, although from the other direction when they think about their mortgage. If you enter into a fixed rate mortgage, you've guaranteed what your mortgage return, your mortgage interest rate is going to be. And if the interest rate on mortgages generally rise, you're in a good position. But if it falls, you're paying more than you need to. Bonds are the other way around, but the same concept. If I enter a bond investment, I agree to receive a fixed 6% a year, and then the interest rate rises to 7%, my bond is not as efficient as it could have been. So what would happen to me in that situation is that I would get my bond price would fall. Now, obviously, if you're talking about, well, I could achieve 7% instead of 6% for 3 years, that's about 3% that I've lost. And if you just wait till your bond matures, you get your money back, it doesn't really matter. But the longer the duration your interest rate is, the longer you fix in that term, the more risk there is. If I agree to receive 6% for 10 years and it moves to 7%, the interest rate moves to 7%, then I've lost 1% per year for 10 years. So a bond portfolio which has a short duration doesn't have very much interest rate risk because there's only so much the interest rate can affect it. You only have to wait a year or two and it's gone completely. Whereas if you take a very long duration portfolio, you can have a much larger swing in the value of your investment. So that when you're trying to design a bond portfolio, paying good attention to the bond duration is quite important. If you're expecting interest rates to fall, you want a longer duration because you're saying, well, look, at the moment, bond yields are around 6 or 7%. And if I could lock that in for the next 10 years, I'm sitting pretty. And if the interest rate drops from here, I don't need to worry about the fact that interest rates have dropped. On the other hand, if you go into a long duration portfolio position because you think interest rates are going to fall and they rise, your bond portfolio can fall in price. Liquidity is a famous one. You may well be aware of the famous expression, it is from Warren Buffett, only when the tide goes out do you discover who's been swimming naked. When you're designing bond portfolios, you need to think about liquidity. Liquidity is the ability to sell your bond when you need to. The bond market as a whole is very liquid and is generally speaking more liquid than the share market, particularly once you start moving out of the largest companies. You will find better liquidity in the larger government bonds, although to be fair, not always in the high yield bonds, which can be a little more difficult to handle. The next thing you need to consider when designing your bond portfolio is foreign exchange. Foreign currency bonds are available. They're available through FIIG. We deal in Australian dollars, US dollars, sterling, and euro, I believe. Foreign currency bonds are typically for more sophisticated investors. And you should buy foreign currency bonds when you're convinced that the Australian dollar is about to weaken. So you can take your strong Australian dollars, go and buy some US dollars with them, invest them into a US dollar bond. If you're correct and the Australian dollar weakens, when you sell your US dollar bond or your US dollar bond matures, you have US dollars which buy you more Australian dollars than when you started. The problem here, though, is that FX risk is quite complicated. It's fundamentally about the comparative performance of two economies. And so even if you think, oh, the Australian economy is going to weaken, so I think the Australian dollar will weaken, if the Australian economy weakens and holds up better than the US economy, which is also weakening, the Australian dollar can strengthen even as the Australian economy weakens. It's all about the relativities. So there are risks in investing in foreign currency bonds. I've been talking a lot about the theory, so I thought it was probably time to show you some actual sample portfolios about how to put a bond portfolio together. This is the conservative bond portfolio that we keep on our website. FIIG always maintains 3 sample portfolios. They're available on our website, fiig.com.au. They show you what we think is a solid way to approach bond investing and a solid portfolio for 3 different risk categories. This is the conservative category, and as you can see, when this was put together on, sorry, it wasn't the 28th of February, it was the 29th of July. I had some trouble with the slides. On the 29th of July, 5.64% return was available, and that was taking a mix of fixed coupon bonds, FCB, capital index bonds, index annuity bonds, and FRNs, some senior debt, some tier 2 debt, but all investment grade, a mixture of infrastructure, property, government, financials, major banks, regional banks. So you've got a good set of diversified sectors in there, 100% investment grade, 5.64% yield per annum. Now that's solid, but it's not that high. And this is the exact list of bonds and the exact details of the bonds we're suggesting. If instead you wanted to be into a more balanced portfolio, you would take a little bit of extra risk and increase your return increase your yield to 6.73% per annum. Now, this is still using a mix of fixed coupon bonds, inflation index bonds, and FRNs. We're using a bit more sub-debt and a bit more tier 2 debt. We're using some unrated bonds, so it's 22% unrated. Remember, I referred to that as a bit like small cap equity investing. So if you're dealing with, say, 20% small caps in your portfolio, that's the kind of level of risk we're talking about in some ways. You are still mostly investment grade. There's a little bit sub-investment grade, a little bit unrated. Still a good mix of sectors, although the property sector is starting to be a little bit higher. But that portfolio will give you 6.73% return. And if you're interested in the exact list of bonds, that portfolio is described on our website. I tried to put it here, but the list is a little bit longer. It's 16 securities with nothing more than a 10% weighting, average yield of 6.73%. If you're prepared to go into the high yield sector and take a bit of more of an aggressive position, you can achieve a return of 8.82% yield per annum. This is a much more aggressive portfolio. As you can see, it's only 35% senior debt, it's 50% sub debt, and 17% what's known as AT1. That's a subordinated debt category. So as you can see, it's 40% sub-investment grade, 60% unrated, but it does provide you with a fairly good mix of sectors and an 8.82% return. So these portfolios have been designed to cover off all those risks that I was talking about. They give you different sectors. They give you I think the high yield portfolio has some US dollar bonds in it also. So I know it does have some US dollar bonds in it also, but it also still has diversification. And importantly, the bond portfolios here provide you with a very strong diversification to balance out against your equity portfolio, which is how you need to stop and consider the investments overall. Now, that is everything I had intended to say. Now, I think I have mercifully kept almost precisely to time. So there is 10 minutes left in the official presentation for questions and answers. I'll hand it back to Prashant to organize the questions. Thank you.
Thank you so much for that presentation, Philip. I certainly learned a lot. And let's look at some of the questions that have come in through the Q&A. If you have any questions, please type them into the Q&A box on the webinar program, and we can get them answered by Philip. So the first question from Alan was, why doesn't FIIG have a bond ETF?
We are actually, it's not quite an ETF, but we are in fact building a fund. That we already have what we call the FAB fund, which is a bond fund that is designed to replicate the fixed income market generally. So if you don't want to take the difficulty of designing your own bond portfolio, you can use one that we've prepared earlier and invest in the FIIG bond fund. That will FAB fund, a fixed FIIG Australian bond fund, FAB fund. That is attempting to outperform the bond index. We also, it's not been sort of publicly launched yet. We're going to be launching it on the 1st of September, actually, something called the FIIG Monthly Income Fund, which is the other part of what bonds can provide you. The FAB fund is providing you that diversification against the equity market. The Monthly Income Fund is providing you with, drumroll please, monthly income. That's why we named it that. It will be investing into floating rate securities, which have quite low duration risk, but provide consistent monthly returns. So that's the two parts of bond investing, to get consistent returns from the monthly income fund and duration exposure, so that you're not, so that you are protected in times when the equity market falls. We don't have ETFs. We do have those bond funds available if you wanted to do either of those.
Yeah. And just to add a little bit more flavor, all those bond funds are available under the Fund AU code in Sharesight as well. So you can track them in Sharesight if you have a managed fund of bonds. So thank you. The next question is a tricky one. I have an ETF which is only returning 1.8%. Why? I guess.
What sort of ETF?
Yeah, so I guess.
I'm sorry, if that's a bond ETF, remember, if you remember back to that chart where I showed the big 40-year drop in bond prices, also drop in bond yields and the big kick up, bonds had a very poor year, well, two very poor years across 2021, 22, and 22, 23, because they were when interest rates were very, very low and then yields started to rise. That is a fundamentally, I mean, and remember I said when interest rates start to rise, bond prices fall. So bonds had a very poor period across that time frame. That's fundamentally not where we are now. Remember that slide saying that 40-year trend, we've broken out of that. So if you're looking at a bond ETF that you entered into, say, 3 or 4 years ago, and you were saying, well, now across the last 4 years, I've got an average return of 1.8%. That's entirely plausible, that kind of number. And that would be because during the breakout of inflation 2 years ago, bonds did very poorly. Now, it's a very different sort of scenario now. We're actually talking about, like, is inflation going to be sticky for just a little while, or is it going to finish? Is the RBA going to cut rates, or is now the active question? The prospect of the cash rate moving another 400 basis points higher, well, that can be pretty emphatically discounted. You can't say for sure that it's not going another 25 higher, but they've gone from 10 to 435. So the prospect of them going another 425, I think we can probably count that out. So you're not going to get a repeat of those last few years. You can't guarantee that it's going to be, I can't sort of guarantee what the return next year is going to be. But that period of inflation across 2021, 2022 did have a negative impact on ETFs and bond ETFs. The other thing that's worth pointing out is that most Australian bond ETFs are investing into a market-weighted investment, where now the government bonds are about 30 to 40% of the market. The state government bonds are another 30 to 40%, leaving you only sort of 20-odd% that are corporate bonds. So those government bonds are incredibly safe and not terribly high yielding. So if you go into those bond ETFs, you tend to get mostly government bonds, which is not what FIIG specializes in. We specialize in corporate bonds. So that's another reason why we don't have an ETF.
Thank you. That was really good. The other question is recording available for this, please? Yes, the answer is yes. We will also share that on our YouTube channel, and you'll also get a copy of the presentation, so I can answer that one. The next question is, do you only do Aussie bonds? What about US bonds?
Yes, we do very much do US dollar bonds.
Yeah, that's good.
Easy one, that one.
Pauline's asking, do you need a broker, or can I buy bonds without a broker?
Well,
I guess because most of us are equity investors, so we have to go through an online broker. I guess the question is, how do you buy bonds?
right. I see. The answer to that is FIIG Securities is a broker in that way. And the answer to that very much, well, without presupposing, I would imagine that everyone on this call will need a broker. The minimum investment in a single bond line in a wholesale market is usually 500,000 Australian dollars. Now, to get a diversified bond portfolio, you really need at least 15. So unless you're talking about investing $7.5 million, you can't go yourself, not safely. If you want to go, now that's where FIIG comes in. We actually pioneered this in Australia. FIIG essentially helps groups of investors come together, and FIIG will buy 500,000, $1 million, $2 million of bonds in the wholesale market and then divide it up in slices of $10,000. So if you're operating through FIIG, you only need a $10,000 investment. Now, I'm presuming that, buying 10 or 15 bonds at $10,000 or $20,000 each. So you're talking more about $150,000, $200,000. That's probably much more the kind of investment that the people on this call are thinking about. That can be achieved through FIIG as a broker, but you won't be able to achieve investing in bond markets and that size unless you need to be a wholesale size to invest directly in the bond market.
Thank you. That's very well explained. Thank you. James is asking, what is the main advantage of bonds over HISA?
HISA, yep, high income savings account. The basic difference is that a high income savings account is still lower than most bond yields. Depending on exactly what you're talking about, they can be slightly higher. The advantage of bonds is, remember in that chart I had, which had bond yields rising during the period, so bond prices rising during the periods when equity markets were falling? A high income savings account is it's an at-call account, it's a cash account, so it has no duration in it. It is the duration inside a bond that says, right, I've locked in a return of 5% for the next 10 years. Oh my goodness, an unexpected recession has come and the interest rates have fallen. You need to have that locked in duration to provide the protection and the negative correlation against equity markets. What happens to that high income savings account? Oh my goodness, a recession has started. The Reserve Bank has slashed rates. My 5% that I was earning is now only 2%, and there's no other change. Whereas if you'd bought a bond for 5% and it falls and the yield falls from 5 to 2, broadly speaking, if you've got an extra 3% a year for 10 years, that's broadly speaking a 30% increase in price. So a 10-year bond would move from 100 to 130. The savings account does not change in price. So to get that negative correlation with equity markets that I displayed in my charts, that needs to be a bond rather than a savings account.
Right. Thank you. That's really good. Chris asks, the tier 2 bonds in the slide, do they have the same non-viability triggers as listed bank hybrids?
No, they are much more preferable. A listed bank hybrid will be converted to equity or written off before a tier 2.
Yeah. Okay.
That's why, if you remember my capital slide structure, I had, subordinated debt, that's tier 2, alternate tier 2. Hybrids are tier 1. So a bank hybrid is signing up to be at the front of the queue. If this bank is losing money and someone needs to take a loss, I volunteer to be first. That's what the bank hybrid is.
Yeah.
And then tier 2 subordinated debt is I volunteer to be second. There is also tier 3, which Australian banks don't issue, and then you head into the senior secured type spaces.
Okay.
So a bank hybrid has more risk than a tier 2 subordinated security.
Yeah, perfect. Thank you. Alan asks, what are FIIG charges? What are the fees, I guess?
Oh, We don't charge fees for trading. We do have a small custody fee, which is, I must admit, I should know this precisely, but I'm not actually in the sales team, so I don't deal with these kind of fees day to day. It's in the vicinity of 0.2% per annum.
Okay. Thank you. A question, what is your comparison with gold as a safe haven during times of turmoil and in the longer term?
Gold is an interesting one. Gold does have some of those safe haven properties. What it doesn't provide, and sometimes it works, sometimes it doesn't. What you don't get from gold is that ongoing guaranteed income. So if you only want the one asset that's going to be left standing, after World War III, yeah, gold might be it. If you want an asset that is going to have a reasonable amount of resilience through the next sort of economic slowdown, and also providing a significant amount of return along the way, including sort of predictable monthly, quarterly, annual flows, that's what bonds provide that gold doesn't. So that's the trade-off you're making there.
Okay, thank you.
Now, sorry, I just want to interrupt quickly. It is 12:45. I'm happy to stay around and keep answering questions for a little while if there are more questions to answer. Are there?
Yeah, there are lots of questions. Thank you for your time, Philip.
That's right.
Okay, cool. So we might just keep going for another 5 to 10 minutes.
Yeah, sure.
Does FIIG hold the bonds in the name or investor's name? Asks Wayne. Now, just for, I guess, the equity equivalent of this, we have CHESS-sponsored brokers versus custodial brokers. So, which means like the share is owned in the name of the investor versus a custodial broker where the underlying investment is in the broker's name. So I guess that's the question. How does
Yeah,
it with FIIG?
it is custodial. Remember I said that the smallest parcel you're allowed to have is 500,000. So FIIG can own the 500,000, and then we keep it in custody for a group of clients.
Thank you. Okay, a speculative question, which is how speculative is bond trading?
Bond trading, this is an interesting one. It's sort of like, how dangerous is it to walk down the street? Depends vastly on which street you're talking about. Government bonds are amongst the safest assets there are. Like, I've spent 20 years working in financial markets. I don't like to use words like never and always, those sort of words. But if you wanted to, you could design a government bond portfolio where you would not take a loss other than in, situations like China nukes Canberra. That's the kind of sort of scenario you're talking about where you take a loss on an Australian government bond. If you take an Australian government treasury note. Now, the flip side of that is you only get a return that looks about like sort of 4% or so, slightly less than that. But those are not speculative at all. They are the safest investment you can have. But if you wanted to, for example, lend money in the high yield space to a startup company, that could come with a yield of, I'm trying to think of one we've done recently, a company called Early Pay. They lend money to people who are buying sort of physical assets for companies. We have one of their bonds that paid BBSW plus 5%. That's around 9.5%. That's quite a lot higher than 4%. And it does come with extra risk. That is slightly speculative. Like, with the walking down the street example, it depends greatly on which street you choose. As a general example, if you're just choosing, the standard market bonds, they are not very speculative at all. You have to actively seek out the riskier speculative bonds. As I said, it is with only 3 investment grade defaults. It's very rare, like over 20 years, 30 years, it's very rare for those investment grade bonds to default. So their investment grade bonds are not really speculative. Non-investment grade can be considered slightly speculative. And as you move down into the unrated space, you get into sort of, mildly or moderately speculative. But still, to be fair, lending a fixed amount of money to a small company that has to pay you back on these days with these legal requirements is less speculatively than buying a share in that company. So even at the riskiest end of bond investing, you are probably less speculative than share investing, or at least anything but, sort of incredibly conservative share investing.
Yeah, perfect. Yeah, thank you. John asks, how liquid are direct investments with FIIG? Is there a secondary market that FIIG runs?
We do run a secondary market, and this, like this question of how speculative is it, varies greatly through bonds, depending on which bond you're talking about. If you're talking about bonds from larger companies like Commonwealth Bank, Westpac, are quite common bonds that we have on offer. They're really quite liquid. You would probably only be talking about a number of days, maybe a week, to recover money from those sort of investments. If you're talking about much more obscure investments, it can be a little bit longer.
Thank you. Where do junk bonds sit? Lower than CCC? Just curious because we heard about them during the GFC.
Junk bonds is not a technical term. It's just a general kind of description. And yes, triple C bonds are junk bonds. It's single C, double C, triple C, those kind of bonds are junk bonds.
Yeah. Okay. That's great. Then there are some questions that are specific to okay, so the Marshall asked, the returns you mentioned before, is that excluding fees?
Yes, any yield, or when I was quoting our returns, that was excluding fees. When the yield we've put on there, that's excluding fees. Well, yes, excluding fees.
Yeah, perfect. There's an anonymous question here, which is again another speculative question, I guess. Why can't interest rates go another 435 basis points? Why is that a no? Oh.
Another 435 from here, because you would double everybody's mortgage cost, and the economy would stop. So like if all 9 members of the RBA board had a mental breakdown simultaneously and wanted to change the cash rate to 870, they could, but the economy would be ruined in like a matter of days. It's exceptionally unlikely to happen. You're talking about incredible tail risk. That is it. I'm a financial sort of person. I don't say never, but yes, it's never going to happen.
Yeah. Marshall says ticker VBND, V bond, Vanguard bond index, I suppose.
Yep.
Not sure what exactly the question is. Yeah. Oh, sorry. I think we should leave that. And then another anonymous question, which is, so what is the management fee for FIIG? Which is, I think, already answered.
There isn't a management fee. If you go into some of the bond funds, there is a management fee. It's 0.58% on the FAB fund, and it's 0.5% on the monthly income fund, but there is no management fee on the direct bond investing.
Perfect. Okay, I think that concludes all the questions from the audience. So once again, thank you so much for your time, Philip. This has been exceptionally educational. I think most of us being very heavily, or almost 100% heavily weighted towards equities, this is a really educational piece. And it's also exciting to know that these bonds are available in smaller parcels of $10,000 investments as well. So that's really useful. Thank you.
Thank you.
Thank you all for those who took your time out and participated in this webinar. We will share a recording and an email and a follow-up email with a bunch of information. Thank you.
Yes. Well, thank you.